Welcome to this explainer. Okay, let's just dive right in, shall we? 2025. We are living in an era where, honestly, investing sometimes feels like finding increasingly creative ways to just literally light your money on fire. I mean, we've seen people pay $450,000 to be Snoop Dogg's neighbor in the metaverse. We've watched people drop $7 million for a digital JPEG. We've seen people YOLO their entire life savings into Dogecoin, make $2 million and then lose it all in less than a year. The opportunities to lose money in modern finance seem truly endlessly abundant. But today I have something extra special for you. We are going to explore a market absurdity so incredibly bizarre, it defies absolutely all traditional financial logic. And the crazy part? It is unfolding in real time right now.
So think about this for a second. Would you ever pay $2 for a $1 bill at a garage sale? Well, of course not, right? Nobody would do that. But Wall Street is essentially doing exactly that right now. I've got a trade for you today that is the financial equivalent of texting your ex at 2 a.m. You know it's a bad idea, your friends know it's a bad idea, but somehow everybody's still doing it anyway. Let's look at how this terrible, no-good trade is actually playing out in boardrooms across the world.
The impossible math happening here is just staggering. Imagine a company with a stash of Bitcoin worth exactly $70 billion. That's the actual real-world value of the cryptocurrency sitting on their books. But on the public stock market, this exact same company is being valued at an unbelievable $138 billion. It's wild. Boardrooms on Wall Street have basically figured out a cheat code. If you stuff your balance sheet with Bitcoin, the stock market is going to pay you $2 for every single dollar's worth of crypto you hold. It's literally that garage sale analogy coming to life.
Chapter 1. MicroStrategy's Historic Pivot.
To really understand how we got here, we have to look at how an underwhelming enterprise software company pulled off a transformation that completely rivals Kim Kardashian's rise to fame. Before this whole crypto madness, MicroStrategy was dealing with declining revenues, a super low market profile, and honestly, they were more disappointing than the new age Jurassic Park movies. But follow this timeline with me. In August 2020, CEO Michael Saylor announced that MicroStrategy was going to transition its cash reserves into Bitcoin. Now, in the corporate world, this was the most revolutionary thing since garlic bread. Historically, companies hold their cash in highly liquid, low-risk securities like U.S. Treasuries, just a safe way to earn a little risk-free interest. Putting corporate cash into an asset that can randomly fluctuate 10% overnight, that was entirely unheard of. Then, in late 2020, Saylor ramped it up. The company started issuing convertible debt, literally borrowing money just to turn around and buy even more Bitcoin. Fast forward to 2025, and they are so all in that they ditched the word micro from their name entirely. They're now simply known as Strategy, which perfectly reflects their complete transformation into a giant Bitcoin vault with a stock ticker.
And the result of this wild pivot? 3,441%. Yep, since 2020, Strategy's stock has absolutely skyrocketed, making it one of the best performing stocks over the last 5 years. They completely transformed themselves from a dying software company into an absolute financial juggernaut, all simply by changing what asset they held in the bank.
Because this strategy, and yes, pun absolutely intended there, has seen such massive success, copycats are just flooding the scene right now. I mean, it literally doesn't matter what your actual business is anymore. You could be a gaming company based out of Hong Kong, a cardiovascular healthcare company, or even a budget hotel management company in Japan. The new playbook is simple. Just announce you're buying Bitcoin, and investors will blindly buy your stock. Logic has officially died in the public markets, and honestly, we are all just NPCs living in Michael Saylor's personal simulation.
Chapter 2. The Institutional Mandate Loophole.
So you've got to be wondering, why are people buying this stock instead of just buying Bitcoin directly? Like, why pay $138 billion for $70 billion worth of crypto? Well, the answer is a fascinating mystery of institutional capital, and the secret lies entirely in one word: a mandate. You see, institutional capital, we're talking massive pension funds, mutual funds, giant asset managers, they desperately want exposure to Bitcoin's incredible gains. But they operate under strict mandates. These mandates are essentially ironclad guidelines that dictate exactly what these money managers can and absolutely cannot invest in. And for a lot of these giant funds, their mandates strictly prohibit holding Bitcoin directly. It's totally banned. So by purchasing shares of Strategy stock instead, they are effectively securing indirect exposure to Bitcoin without technically breaking their own rules.
And this creates some truly incredible irony. Get this. The Vanguard Group is actually the largest shareholder of Strategy. Just think about that for a second. Vanguard is famously a massive crypto skeptic. They have made their negative opinions on Bitcoin very well known to the public, and yet they are the biggest buyers of this stock solely to get indirect access to the very asset they claim to dislike. Strategy is essentially providing these massive money managers with a convenient, easy workaround.
But the financial toll of this little workaround is just massive. The actual Bitcoin value sitting in Strategy's digital wallet is $70 billion. Yet Wall Street is currently paying $138 billion for the company. These massive money managers are so desperate for Bitcoin exposure that they are completely willing to pay a 100% premium, basically a massive convenience fee, just to get that indirect exposure. This entire circus, all these financial gymnastics, the 100% convenience fees, pretending to hate crypto, it could literally all be solved with one simple mandate change that allowed them to hold Bitcoin directly. But until then, they pay double.
Chapter 3. The Convertible Debt Trap. Now, if you think Strategy has this all figured out and it's just a flawless victory, we really need to look a little closer. Because on paper, they seem to have a brilliantly simple 3-step get-rich-quick scheme. Step 1, issue convertible debt to raise capital. Step 2, throw every single borrowed dollar directly into Bitcoin. Step 3, sit back, relax, and watch the magic happen as they profit from the appreciation in both Bitcoin's price and their own soaring stock price. Honestly, it looks completely foolproof.
Now, what's really interesting about this setup is how quickly it falls apart, because that illusion shatters with just one word, wrong. Since Strategy is purchasing Bitcoin with the proceeds from convertible debt offerings, the entire risk profile completely changes. This isn't just your standard everyday risk of a margin call. The true danger here lies in the very nature of convertible debt itself. When this debt inevitably reaches maturity, Strategist has to make a choice, or rather, the bondholders do. The company has to either repay the principal of these huge loans in cash, or the bondholders can choose to convert those bonds into shares of Strategy stock. And if bondholders choose to convert those bonds into stock, it would lead to extremely heavy stock dilution. And that massive dilution would drastically, and I mean drastically, negatively impact the stock price.
But wait, it actually gets even riskier. 600,000. That is roughly the sheer volume of Bitcoin Strategy currently holds, which they purchased at an average price of $71,000 each. The absolute primary risk for Strategy isn't just their stock price taking a dip. The real existential threat here is whether they can actually meet the strict interest and principal repayments on their massive debt obligations if Bitcoin's price drops significantly. If Bitcoin crashes, the piggy bank empties out, but guess what? That debt remains.
Chapter 4. The Worst Trade Ever.
So let's pull this all together. Strategy is a company that's no longer really a traditional company at all, right? It's just a glorified Bitcoin wallet. Yet it has somehow managed to convince the world's largest institutional investors to pay literally double the value of the actual assets inside that wallet. I really want to leave you with this final provocative thought. Have our public markets completely abandoned logic to trust a former software company with billions in debt? To add a cherry on top of this whole thing, the very institutional investors who loudly claim they don't trust Bitcoin are currently trusting a former enterprise software company turned Bitcoin piggy bank to manage billions in convertible debt on their behalf. It is arguably the worst trade in the history of the stock market, just hiding right there in plain sight. Makes you wonder just how smart the smart money really is, doesn't it? Thank you so much for joining me for this explainer. Keep asking questions, and I'll catch you next time.